Welcome to ORE. This is the first part of a course of videos training you on ORE's web platform. You can practice trading with a free demo account at optionsareasy.com. In this tutorial, I'll be guiding you through the new mode of trading. From optionsareasy.com, you can sign up for a new account or log in. This platform is designed to help you develop as a trader. It comes with 3 modes of trading: new, basic, and advanced. When you first log in, you'll be asked about your previous experience in trading options. If you have no experience, you will need to click Go New. The platform has logged this information, and when you go to Add a Position, it takes you to the new mode of trading. The new mode is very simple. At the top, you can monitor the current market rate of the pair that you want to trade. And underneath, you have 2 option trade tickets. Now, using an option, you can reserve a buy or sell price in the market. The name for this reserve price is the strike. For this option ticket on the right-hand side, the strike is currently 1.1404. The reserve price is to either buy or sell a certain amount of asset over a certain period of time. In this case, that is to trade at 1.14 for an amount of 20,000 euros over the next 7 days. The cost to buy the option is called the premium. Here, this option costs $140, or in my domestic currency, that's 91 British pounds. If your reserved price subsequently beats the market price, the option trade will pay out. Now, there are 2 types of options: a call and a put. A call on the right-hand side here is used to reserve a buy price in the market. Hence, you would buy a call if you expected the market to rise. And a put is used to reserve a sell price in the market. Hence, you would buy a put if you expected the market to fall. Now let's focus on the call option for now. Here I am speculating on the price of euro-dollar over the next week. And if I think this pair will rise, I can reserve the current rate of 1.14, and this will cost me $140. Now, to view the potential profit from this trade, I click on this chart icon here. Here you are given a scenario chart and table. It shows you the payout over a range of market rates. The vertical axis is the profit or loss, or the payout, and the horizontal axis is the market rate. The blue line here indicates the current market rate. The reserved price, known as the strike, is noted at the top here, 1.1402. Remember, we said that if the strike rate can beat the market, the option will pay out. You can see here, as the market rises, the profit of the option trade increases. If we look at this point here, the market rate is around 1.15. Yet with my option, I can buy at 1.14, which is 100 pips better. Hence, the option will pay out. And notice how the option's payout is unlimited. But what if you are wrong? What if the market falls? Well, it means that your strike is worse than the market rate. So the option is worthless and does not pay out. In this case, you would lose the premium you paid for the option. That's $140. Now notice how the loss is limited, no matter how low the market goes, and you cannot get stopped out. This protects you against volatility. The market could drop, before rising above your strike rate, and you would still be in the position without the need to add more margin. Now underneath the chart is a table. The first column gives a range of market rates. The second is the amount you pay for the option, in this case $140. The third column gives you the premium of the option's value, the option's payout at expiry, so in 7 days' time. And again, you can see that as the market rate rises, the payout of the option rises. So at 1.1752, the option's going to pay out $700. Now, if you deduct the original amount you paid for the option, $140, then you get the net P&L, $560. On the other hand, if the market falls, so here if the market fell to 1.1122, the option does not pay out. It's zero. So my maximum risk or my maximum loss is the amount that I originally paid for the option, $140, and you can see that the loss is $140. And no matter how low the market rate goes below my strike, my loss is always limited to $140. Now let's just have a quick look at the put option. This is the ticket on the left-hand side. Again, this allows you to reserve a rate in the market, but this time you're reserving a rate to sell. Here you can see that the strike rate to sell is 1.1404. Hence, if I buy this option, I will have reserved a trade to sell 20,000 euros at 1.1404 over the next 7 days. And this will cost me around $138. If the market falls below my strike, I will make a profit, as you can see here in the scenario chart. And as the market falls lower and lower, the profit will rise. If I am wrong and the market rises above my strike, then I will make a loss. Again, this loss is capped to the amount I paid for the option. Now, throughout the platform is this Educate On button. If at any point you need help understanding any of the elements or descriptions, you can click this. It takes you to an education mode where you are free to roam and hover your mouse over any of the highlighted elements to learn more. And once you're done with learning, one click takes you back into the trading platform. So in summary, in this new mode you only have 2 decisions to make. Which pair do you want to trade, and do you expect it to go up or down? You can select the pair from the top menu. Here you can choose over 20 different currency pairs, gold, silver, or WTI crude oil. Then you decide if you think that this price, the market price, is going to fall or rise. If you think it's going to fall, you would buy a put. If you think it's going to rise, you would buy a call. Here, if I expected the oil price to rise above 52.50 in the next day, I could buy this call option and it would cost me $47. If I'm happy with that cost of $47, then I simply click Trade Now. The position is opened and I am taken to the open position screen. And here's my open trade. I can see the expiry date, how much I paid for the option, $47, and how much the option is currently worth now, $40, so the amount that I can sell it back for. The difference between the amount I paid and the amount I can sell it back for is my profit or loss. And because this is a call option, as the market rises, this premium now will also rise, hence my profit will rise. I can close this trade at any time. I do not have to wait until expiry. To do this, I simply click this box on the left-hand side and click Close Selected Positions. Or if I do wait until expiry, which is 10 a.m. New York time, the option trade will be automatically closed and the premium now will be credited to my account. From the Open Position screen, you can click Add Position to get back to trading. You are taken again to the new mode of trading. Now you may have noticed in this mode you cannot choose the strike, amount and expiry. These are always fixed. But when you are ready, you can go up to the next level of trading by clicking this link in the bottom left, Create My Own Trade, to tailor your own option trade. In the next lesson, we'll be looking at the basic mode of trading. Here you can create your own trade. If you have any questions about this lesson, new to options, please don't hesitate to email us info@ore.com.